okay, as we go along. And so Ben, I think at this point, Ben, you can start the recording. I think you have access to, you are a co-host already, so you have permission to do the recording. So today is week 2. We want to continue from where we left off. And today we are looking at accounting concepts, principles, bases, and standards. Okay, now based on our learnings in week 1, we identified the different users of accounting information and their needs, their information needs. Unfortunately, we cannot prepare tailor-made financial information for each group. Other than that, that will be a Herculean task. And so because of that, we prepare what we call a general purpose financial statement that every user can be able to pull the information they require from it. In order to do that and prepare the financial information, we have a common framework. This framework helps us to prepare and put the information in a way that everybody can access and everybody can understand. And so a picture frame, just cast your minds back to your homes, to your rooms where you have frames, okay? So that frame is very permanent. It's like a structure that has key things in there that hardly changes. In accounting, we also have a common framework that sets out the basic guidelines of what we do. And as accountants, we fall on this framework for preparing and presenting the financial information for all the different users. Okay, I did indicate that we cannot prepare tailor-made for everybody. So we put all these together in what we call general purpose financial information that can address the different interests of the various users. So for today's learning objectives, I expect that at the end, students will be able to explain the conceptual framework and identify the elements within the conceptual framework that has been put together by this body, the International Accounting Standards Board, okay, and this body seeks to put these things together where there are challenging issues in the area of accounting. This group goes back to the framework, looks at the challenging issues and bring out guidelines for all accountants to follow. So it's a very important group, the International Accounting Standards Board. We should also to state and explain the qualitative characteristics of accounting information. So it's not any information that meets the accounting needs. So for it to meet, for the information to be regarded as meeting the interest of the users, it must have some characteristics and we would understand them. Then we would also explain the accounting standards. Okay, these are specific guidelines that helps us in the treatment of accounting transactions. And now I know when I mention transactions, we understand. So we have guidelines that helps us to treat every transaction the way we have to treat it. We would also understand the fundamental concepts and principles of accounting. These are all just terminologies that are used for the various guidelines, okay, and basic issues that arise in accounting that has been put together to guide accountants in preparing financial information. And then finally, we would look at the different bases of accounting, okay, which one we use. For our reading list, we still have chapter 2 and 3 of Mafu, Edem, and Taki. For those of you who have the Frank Wood, Okay, like I did mention, Ben has the current version, which is 2010. That's good of him. Chapter 10, you would have to check whether the same chapter 10 refers to the readings on concepts, principles, policies, and all others. So please, as you pick your Francoud text, you have the soft copy, you would always have to make sure that the text relates to the topic we are treating for the week. So we'll start with the conceptual framework. Okay, so a frame is just a picture, just cast your mind, a picture frame. Okay, and we know how picture frames are. The frame does not change, but we can always change the picture. So the framework is just a structure that contains all issues that relate to the development of reporting practices over time. Okay, the guidelines that have been agreed upon, okay, internationally, that helps us to prepare the financial information in a certain order. So whether you are in Afghanistan, whether you are in Kosovo, whether you are in Ghana or Kenya, you can use the same principles and the same rules apply. And so that is what the framework is supposed to do. Okay, it has basic guidelines, okay, that are accepted worldwide for developing practices and guiding what we do as accountants. Now, this framework, one of the aspects is that it has the guidelines for the standards that we use. I mentioned that the standards relate to how we treat the transactions in the recording process, okay, how we treat those transactions. And so that will be found in there. The framework also helps us to resolve conflicts and disputes relating to accounting transactions that are very challenging and nagging. Okay, don't assume that all transactions are just very nice. No, it can be very complex transactions where we'll have to get back to the framework, look at the fundamental ones, and try and evaluate and try and think through to arrive at consensus, which becomes a guiding principle. So in that framework, we have some guidelines that help us, okay, to do all this. And to also make sure that some of the fundamental principles are not repeated. We are not doing this one this way and doing this. There is consistency, there is coherence in what we are doing in a bid to record and provide financial information. Now let's look at what the content of that framework. And so that is what we have as the content. In that framework, the first point is that the users of accounting information has been clearly stated. Okay, we've learned that we have internal and external users in our lectures for week 1. And I'm sure most of us can easily identify who internal users are and also list and name those who are the external users. Okay, so the guideline as to who users are have been agreed on and incorporated in that framework so that everybody who is preparing the financials know that for this financial statement, these are the category of people for which we are preparing the general purpose financials. Within that framework, we also have the informational needs. Okay, so the setters of the framework came together to think about what possibly each user would need, and they incorporated it into the preparation of the accounting reports. And that is why I indicated earlier that it is known as the general purpose. So every user has a little bit of their information needs in there. In fact, not a little, have their information needs satisfied in there. Depending on what you want, you would always get it in there. So the framework agreed on what their user needs are in order to determine what information we should report and present out there. Then it also tells us what kind of reports, based on who the users are and their information needs, what kind of reports will satisfy those users. And so we have the kinds of reports. Again, in lecture 1, we have identified the reports that are generated, the statement of financial position or the balance sheet, the statement of profit or loss or income statement, the statement of cash flows, changes in equity, and the notes to the accounts. Okay, so it is clearly outlined in the framework. Then it talks about the characteristics of financial statements. Okay. Then it also tells us how to recognize elements within the financial statement when we see one. So it gives guidance on definitions, okay, how to identify the various components of each report as we go along for guidance to accountants. Finally, it tells us how to measure, okay, how to put value and where to send those values to, okay, of the various transactions that will occur as we go along. Now you would notice that we have already outlined users in our lecture 1. We have also talked about their information needs in lecture 1. We have also talked about the kind of reports in summary in lecture 1. And so for this lecture, we are going to talk about the characteristics of financial services. Then in subsequent lectures, we will talk about recognition and measurement. So we'll talk about the characteristics and look at other issues within the framework. So these are the 4 main qualitative characteristics that every accounting information should have. Okay, the first one is it should be very relevant. Okay, and the standards for the frameworks have relevance in terms of these 4 issues. For information to be relevant, it should influence the user's decision. Remember, we have identified the users. And so that decision you want to make, the information that has been made available should help you either alter your decision or affirm your decision. And so it should influence the user's decision to be relevant. It should also have predictive value. What do we mean by information having predictive value? It means that the information should be able to tell us something about the future. Not necessarily about 10 years from now. No, that information will not be relevant. But within the next 1 year, 12 months, 3, 6, 12 months, information I have today should be able to help me make some decision or come to some conclusion about the business within the next few months. Okay, so it should predict, okay, some occurrences into the future. Of course, not the very long term or the long term. We are talking about the short term future. Then it should have confirmatory value. So that information may have also confirmed what we predicted in the previous past, largely, not 100%. Okay, so it should be able to help us confirm some of the issues that we envisaged in the previous one. Finally, to be relevant, that information must come on time. Okay, so we are in 2021. Around this time, most businesses are bringing out their financial information if their year end is December 2020. The question is it timely? Okay, for purposes of putting it together and allowing the auditors to review it, then the stock exchange, and then the stock exchange also gives 3 months period after the year end, okay, to put together and review and present the financials. And so, yes, based on all these regulatory issues, then we can say it is timely. But if the information relating to 2019 is coming now, then it is an irrelevant information. If information relating to 2022, we are having it now, it is irrelevant. Okay, at this point, we don't need it. It will not influence any decision. Okay, we are in a changing dynamic environment, and so we cannot do that. So that is it. The next one is that the information must be reliable. What do we mean by reliability? We should be able to bank our hopes on that information to help us make a decision as to how we want to. Now, before we can say it is reliable, it must be complete. Meaning that for every transaction and activity that took place within the organization for that period, the business entity must report everything. The organization or the company or the sole proprietor or the partnership must report everything. Everything must be included in that financial report, okay, for it to be complete. 2, it must faithfully represent what it purports to be. Remember, most of the users are not in the organization. The financial statement represents the only means of determining what is happening within the organization. So if there is cause to think that it does not report the true picture, people will no more rely on the financials. And that is why we have one aspect of the profession going in to do a review of the financials, and that is the audit profession. So the auditors, the KPMG, the PwC, if you have heard them, they go in to do review of the financials that have been prepared by management, okay, in order to make sure that they have reported and they faithfully represent what the information is within the organization. So that will satisfy the faithful representation. Then it must be neutral. Okay, remember we've talked about the fact that the users have different and varied interests. We are unable to prepare and present financial information to suit their individual interests. And so management must be careful to prepare and present financials that are general, that everybody can pick something out of, and not to skew it to one group of users. And so the information must be neutral. Finally, it must be prudent, meaning that when we have options, and we'll come to see that in accounting, there are certain times we have options. When we have options, we must err on the side of caution, okay, to make it more reliable. Otherwise, if we err on the side of excitement, we would realize that we may overbloat the financials. We may report things that are non-existent, that we have overdone. And so it is very important that we err on the side of caution. Priscilla, do you have any question? Okay. If you have any question, yes, Benedict.
Yes, Madam, please, the prudence, I didn't get it. And the faithfulness, my mind was
I'm
destroyed.
saying the faithful representation suggests that the financial information we are presenting must represent what it purports to be. What does that mean? Remember, the users are mostly external users. So if you are presenting the information as the only means for them to assess your performance, then you must report and let them know that whatever you are reporting actually represents all the occurrences that occurred within that period. Are you okay? And I'm saying that to be able to do that, the auditors, which are an aspect of the profession of accounting, go in there to do verification, to do a review of what management has presented, so that there can be a double assurance that whatever management has presented, the auditors have gone to the business and have also found the same thing and are reporting in line with what management has presented. So that is the faithful representation. It faithfully represents what is in the books of the business. Remember, you and I, as shareholders, cannot go and tell the organization that we have bought shares in to open the books for us. No. We can only do that through the financials and at AGM when we have a question. So we appoint the auditors to go in there and do it on our behalf. Okay. Then when it comes to prudence, I'm saying that in the course of preparing the financials, there are times we have various options. And the option may be to do this or to do that. Anytime we are faced with that, okay, it is expected of accountants to err on the side of caution, not to overdo things that will show a very good performance when in reality, that may not be it. And that is the prudence. We are very conservative. Okay, we err on the side of caution in putting out the figures. Because sometimes you see a business is doing well, all of a sudden it's collapsed. Okay, sometimes it's because some of the reports are not realistic. So we try to put in realistic figures. Yes, Akwesi Apia. Akwesi Apia.
Sorry, madam, it was a mistake.
Okay. There was another hand up before that.
Yeah, madam, it's just me.
It's okay.
Yeah, please.
Okay. So that is faithful representation and prudence. Now, the next one I'll talk about is the comparability. Comparability suggests that all the information contained in the report, we should be able to compare over time. All the information must be consistent, okay? So that we can compare our performance for this year against the previous year. If we keep changing the rules, it is possible that we'll be reading oranges this year, next year we'll be reading pineapple, okay? And it will not help us in decision making. Remember, fundamentally, all we are doing is to help the users to make what? Decision. So every information we are putting in there should be geared towards making sure that the decision they are making, it is good, okay? So one of the key things is to compare, to be able to make decision. So we can compare our information for previous year, we can compare even over time, 3-4 years. But in order to do that, then we need to apply consistency in the rules that we have used in preparing and putting together the information. Once we keep changing the rules, then you should know that users cannot make decisions. It will be difficult. And so one of the characteristics is to enable users to make decisions, and they should be able to compare, okay, whatever information they have, either with previous period, either with other people, whatever, other items within, they should be able to compare. That is very necessary. And to be able to do that, we must be consistent in the application of the rules that we have used. Okay, and finally, to be able to compare, we must disclose every policy or rule that we have used in preparing the financial statement. And so that is disclosure. So we'll disclose all the policies in the notes. Finally, fundamental to qualitative characteristics is the fact that accounting information should be understandable by people who have basic knowledge in accounting. Okay, it should be understandable by people who have basic knowledge in accounting. So how can we enhance this understanding? We can enhance this understanding by providing further and better particulars in the notes to explain some of the issues which have been compressed. Remember, I did mention in lecture 1 that the information is normally compressed. Maybe from January to December, you will see significant figures. You will not see every transaction. But for some of the transactions, we need to provide further explanation to make it understandable. So those are the qualitative characteristics and the issues that explain the qualitative characteristics. So the 4 qualitative characteristics are relevance, reliability, comparability, and understandability. But in order to explain them, then we use these other items or issues. Yes, Benedict.
Please, Madam, is faithfulness and the disclosure of accounting policy same in somehow? Because if you are faithful, you don't have to lie about the accounting information, and disclosing accounting information, you have to be faithful to do that.
Okay, so you are disclosing because you want people to know the policies. Disclosure here is not talking about you presenting everything. You report everything. That is faithful representation. But some of the information is compressed. Do you get it? Because we cannot disclose each and every transaction as they occur. So all we are saying is that make sure every transaction that has occurred finds its way into the elements of the financial statement. That is faithful representation. But disclosure has to do with other information that is required for us to do comparison. So for instance, the policies and the rules that you used, we cannot disclose every transaction on the face of the financials. That has been compressed in the report, but we cannot disclose each and every one of them. So there are 2 distinct things. Look at disclosure as disclosing the rules and guidelines that have been used in preparing the financials. And this is what we mean by disclosure here. Benedict, are you okay?
Yes, please. Yes.
Okay. So we go on to the generally accepted accounting principles. Generally accepted accounting principles, otherwise known as GAAP. Now, I told you that there are a lot of terminologies we would have to appreciate, okay, and get to understand and get to know for purposes of multiple choice, okay, for purposes of filling the gaps. All these are very relevant. So get to know them and understand them. So generally accepted accounting principles, or known as the GAAP, is just a term, okay, used to describe how the financials are prepared. The guidelines that have been put together, okay, over time, from all the changes in the environment, from changes in regulations, from changes in accounting standards, from best practice, from all these, okay, the standard setters or the international body put together, okay, how we can prepare financials. And that is the embodiment of the guidelines. Okay, it is known as the generally, so as the name suggests, they are generally accepted guidelines that you and I cannot easily change. The only means we can change it is when there is a best practice in Ghana, and then we route it through ICA, which happens to be the regulatory body in Ghana. So they'll go through ICA, they'll send notices to all chartered accountants to make inputs. Once they make the input, the board sits down and looks at all the inputs and comes to a conclusion. So these are guidelines known as principles that regulate the profession of accountant. And all these have been captured from regulations. So if we have the stock exchange information, Some of it can find its way there to guide us. The statutes, so if it's about banking, the Bank of Ghana Act. If it's about mining, there might be some aspects relating to mining that would inform us. The standards are the general guidelines for treating the transactions, and then best practice, okay? Sometimes these best practice are brought from other developed countries or other countries. People give their suggestion, and when they find it suitable, they adopt it, review it, and then it becomes a principle, okay? Then we also have the concepts, okay, and the principles. So the generally accepted principle is the general one, the embodiment. Under that, we have the accounting concepts. Now, the concepts are broad assumptions. So like economics, which we always hold, we are holding all other things constant. Then you can determine your demand and supply. Yes, Anthony.
Madam, please, with the accounting principles, I want to know like the body of individuals who are responsible for, putting down or formulating this principle for the accountant to follow.
So it is the international body. Okay, I told you that one of them, for most of these principles, there are aspects of it. The body is known as the International Accounting Standards Board. Now we also have what we call the International Federation of Accountants, okay, to which every accountant worldwide, once your regulatory body is part of it. So in Ghana, ICA is part of IFAC. And so every accountant, I am a chartered accountant, I belong to ICA. I belong to ICA body. So once I belong, every information from the International Federation of Accountants, okay, will come through ICA to me. There are times when there has to be changes in these principles and guidelines, and they will route it through every member for you to make your comments and give your suggestions for it to be considered. So there is a federation of accountants who look at this. The aspect relating to the accounting treatment is handled by the International Accounting Standards Board. Are we okay? So that is it. So there are different groupings, okay, but in every country, there are regulators, regulatory bodies who are supposed to oversee. I can see two hands raised. Yes, Ebenezer Nto. Yes, Ebenezer.
Okay.
Ebenezer.
Madam, please. I want to ask, if we all belong to the same international accounting body, why is it that sometimes when the qualifications that we have, sometimes if someone belongs to ICAG, it is limited to only Ghana. But if someone using ACAG,
Ebenezer, I won't let you land. Ebenezer, I won't let you land. That is a wrong perception. It doesn't belong to ITA, Ghana. So let me correct that conception before we continue. Okay, if it belongs to ICA Ghana, people will not be working at KPMG who are accountants and who have done ICA. KPMG, PwC are international organizations. But people are working there, and sometimes when they leave to other countries, they join the organization there as well. Okay, so the accountant profession, the only thing is that there are different professional bodies. So every country decides which professional body to belong to. It doesn't mean if you are writing ACCA, then you can work everywhere. And when somebody writes ICA, you cannot. It's a wrong perception. So let me correct it before we even continue, okay? What you have to note is that different countries may, and I'm using the word advisedly, may have their own accounting standards. For that one, immediately you get to that country, in order to prepare and present the financials, you have to learn their standards, but not the profession. As for the profession, once you're a professional, you're a professional. of course, other countries like the legal profession, you know that when you go and do your legal thing outside, when you come to Ghana, you have to learn the Ghana legal environment. So you have to do the Ghana legal law. That is the issue. But it doesn't mean that once you're a lawyer, you're a lawyer everywhere. Okay, so that is a wrong perception. Yes, who else? Another person's hand was raised up. Okay, so we continue. So another guideline you would see is the accounting concepts. And I'm saying that the accounting concepts are broad assumptions. Okay, and I was just trying to use economics as an example, where you'd realize that economics would tell you that all things equal. So at that point, they are holding all the environmental issues constant. In the same way, okay, accounting concepts are just the assumptions, which we will hold constant, that underline the preparation of periodic financial accounts of businesses. Okay, so we assume this will happen, and so we hold that constant in our minds, and so it allows us to do things the way we would prepare it. So those are accounting concepts. And in the course of the class, we'll see some of the accounting concepts. Then we have the principles, which are the general rules that have been derived from the objectives. Every transaction, we have an objective. Every accounting issue, there is an objective. When the standard setters and the people who put together the principles, when they are putting it together, the question is, why do we have to do this? This transaction, what challenge does it bring? And so once they are able to arrive at consensus, that becomes a general rule based on the objective of what we want to do with the accounting and the development of accounting techniques. So those are accounting principles. They are just general rules that have been arrived at, okay, after deliberations, after all the JOJO, that becomes adopted across, okay, across continents. So those are accounting principles. Then we have accounting techniques. Now the techniques are the specific ones that we adopt. So there are the general rules, but we also have specific rules. So the specific rules that we use to account for transactions, okay, that face every entity, you would have to refer to the general to be able to adopt which one suits your environment. So the general are just the general rules. If you have specific issues in your environment, you go and start analyzing the general and see how you can branch off. And the specific ones you adopt and use in your preparation is what we refer to as accounting techniques. Okay, accounting techniques. So we have various ones. We have an example provision for depreciation. We'll see that as we get to computations. Then we have the accounting basis. Okay, on what basis are you preparing? In that case, okay, these are the particular methods. These have also been developed by these standard setters, okay, and allows us to make a choice between one or two of them. So the depreciation methods, these are different methods that we have. Which one you want to apply depends on you. Okay, depends on the organization, depends on the accountant. Okay, so the particular method that have been developed and which you want to use in recording your financial transactions, these are the accounting basis. Okay. Then we have the accounting policies. Now, a policy is just the specific accounting principle. Remember, we said accounting principles are the general decision rules that has been arrived at internationally by consensus through deliberations. Now, for every business organization, out of the general one, you would have to use some, okay, that are applicable to your business. So the specific ones that you pick and apply to your business entity become your policy. Out of the general, there are a lot of general, so there are general ones. The specific ones that you pick, rules, and the methods that you want to use as a business organization, okay, for your activities becomes the policy. Just a minute, class, just give me a minute. Let me just talk to my colleague here. Okay, so that is it. Sorry about that. A colleague just walked in. So those are the accounting policies. Then we have the accounting guidelines. Now the guidelines for every transaction, we have a way we have to treat it. Okay, so the accounting standards provide guidelines for treating important accounting items that we have. Okay, there are so many procedures that we can use. And so the guidelines will show us which of the procedures to use. Okay, show us the procedures that we have to use. And so the accounting standards are also there and we have to use them. Now, with respect to the accounting standards, in Ghana, currently, we are using the International Financial Reporting Standards. We have about 1 to 41, and then we have 1 to 16. So 41 plus 16, of course, some have been repealed, okay? So it used to be International Accounting Standards. Then every time they are reviewing it because of the changing dynamic environment. And so now the name for these standards, these guidelines, is the International Financial Reporting Standards. And we have the International Accounting Standards, 41 of them, guidelines for various treatment of various issues. Then the IFRS, which is the current one, which is added on. So when they repeal the old one, they put together a new one. We have about 16 or 17 of the new ones. So the old ones that have been repealed, meaning that they have been old, outdated, so they pull them off, review it based on the environmental issues, and then they put in a new guideline for us to use and adopt. So now we have about 17 IFRSs, okay, talking about various issues and how we should treat them for purposes of accounting for them in the books. Okay, for public sector, it is known as the IPSAS, the International Public Sector Accounting Standards. For auditors, those who review, they also have guidelines they use in doing the work they do. It is known as the International Standards on Auditing. So in Ghana, we have adopted these three in the area of accounting, and that is what all accountants are using wherever you find yourself. Now, in other countries, they have their own accounting guidelines for the treatment of transaction. Okay, so of course, that should tell you that everybody can decide based on your environment, based on your issues. Okay, you can decide. For instance, we found oil. We can decide based, but you see, we must always make reference to the conceptual framework. We must always, that becomes the guiding, the guideline, that becomes the main guideline. So if we want to set our own standards on how to treat transactions, we must first take it from the conceptual framework. Who are the users? What do they need? And so when we record those transactions, is it going to help them? If we cannot, then we have to. So in some countries like the US, they have their own standards in treating their transaction. There are similarities, okay, as we go along, but they have decided to coin theirs and name it the US GAAP. The Australians have theirs, known as the Australian Accounting Standards. The UK also have theirs, known as the Financial Reporting Standards. Okay, so there are so many countries who have developed their own accounting treatment guidelines. In Ghana, we have not been able to do it. And once you have not been able to, then you have no option but to fall on the international. That is, everybody can adopt that one. Okay. So we come to what does GAAP stand for? So the US is saying US generally accepted accounting principles. That's how they have named this. Okay, generally accepted accounting principles. So that is what it means. We come to the concepts, and I did indicate if I should refer you back to accounting concepts. Okay, we said they are broad assumptions that underline the preparation of the periodic financial. And let me also recall that I told you that these assumptions, we hold them constant, just like the economic students or econs will tell us that, okay, the higher the demand, the lower the price, all things being equal. So we are holding all other situations constant in order to agree, okay, to the idea that when demand is more, it automatically means that the price is less. We have held all other things constant, because if everything comes on, it will not hold. So in accounting, we also have assumptions. We assume certain things in order to prepare and present the financial. The first one is going concern. Okay, the going concern concept. What does this mean? It means that we are assuming that every business will not end now. It will continue forever. Okay, every business will continue in operations for some time, for the foreseeable future. And so there is no intention to cease operation. That is just it. So now we assume this in order to value our assets. Okay, in order to value our assets. Okay, every business entity will continue, and the owners or management normally don't have any intention to stop operations. So it will continue forever. Now, once we assume that, we are able to value the business at the acquisition cost of the assets. Okay, based on this assumption, all assets and expenses that we incur, we can put the value we acquired it at inception on it up till the point where it liquidates. And I would explain this again later. So hold that. Okay, so you realize they say assets of the business should not be valued at their saleable value. Okay, it can be valued at the acquisition cost, the cost at which you bought that asset. Why? Because that cost can remain on the book, on the face of your report forever. Why? Because we know the business will continue until you dispose of that asset. The other assumption is that transactions and events should be recognized, or is recognized and recorded immediately they occur in the period in which they belong. So you cannot have transactions relating to January and keep it till next year, January. No, you are not matching the transactions to the revenue they are attracting. Okay, so the effect of those transactions whether it will increase your revenue or reduce your expense, you must take it now and not later. Okay, you must record and report it in the period it relates. So don't defer your transactions, okay? Yes, Abuna, I'll go over going concern when I get ahead, okay, to explain the second point to you better. So just take note, I'll do that. Okay, so that is the accrual or the matching concept. Then we also have, okay, there's a hand up, Goka. Yes, Kezia. Kezia.
Madam, please, it's a mistake. Sorry.
Okay. Then we also have the business entity concept. And you would have to take note of this concept very critically. Okay, the business entity concept suggests that the business is separate from the people who manage or own it. Again, let me take it. The business entity is separate and distinct from the people who manage or own it. What does this mean? It means that for every business, in law, the business is a legal and artificial person. It's a separate legal entity. It can sue in its own name and be sued, meaning that the business is an artificial person. The only issue is that the business cannot act on itself because it is artificial. So it is the people who manage who act for it. Now, this entity allows us to record transactions for the business. And I'll give you an example. If I have Edem Water Company, and I give you a transaction to say Edem Water, when Edem Company or Edem went to buy water with cash, you have to be careful you are not recording my name. What have we done for the business? I am only acting on behalf of the business because the business cannot work. The business cannot act to go and buy water. And so the business entity concept allows us to record transactions, activities for the business in the name and in the books of the business. Okay, this will form a basis for our recording in subsequent lectures. So be careful and take note of that. Then we have the money measurement concept. Yes, Rebecca, the business entity concept also applies to the sole proprietor. Okay, it also applies to the sole proprietor. The business is distinct. The only thing is that most often the sole proprietors, they mess up everything. They don't keep the records of the business separate from their own records. But if you want to be a sole proprietor and you want to show the activities of your business separate from you as an individual, it is possible. Okay, it is possible. Okay, somebody wanted the accrual concept to be explained again. And I'm saying that the accrual concept suggests that you accrue or you record transactions and events when they occur, you recognize it. Aside that, in the period they occur, you must match all revenues and expenses. Okay, you must put all the transactions in the period they occur. So that is it. Then we have the money measurement concept. At the inception of our lecture 1, I told you that every activity must be quantified for it to become a transaction. And this is what we hold on to. The fact that the money measurement concept assumes that we only record financial transactions that are measured in monetary terms, or we only record activities and events that can be quantified in monetary terms. So if the thing cannot be quantified in monetary terms, accounting cannot record it. That is just the basis. And this is what we hold constant. That look, every activity that occurs, we can reduce it in monetary terms. So reduce it, and let's provide the information for you. And I was giving the other class an example of, if you have skills and expertise, why do business employers put people into grades based on their certificate and based on their skills? It means they are quantifying your certificate and they are quantifying your skill in monetary terms and equating it to be able to determine your salary. So if you have a skill or an expertise and you are supposed to be promoted and you are not promoted, it means that is not being measured because it has not been quantified. Okay, so that is another assumption we hold on to. But we are mindful that money does not also have a constant value. So when I joined my organization, if I was earning, maybe as a graduate, I was earning 1,000 cedis. Today, if you finish and you are a graduate, you will not earn 1,000. Okay, the going rate may be 2,000. It is because money does not have a constant value and changes over time. So the skill I had and the time I went and what you have, though our skills are the same, the money value, okay, has changed because of time, the time value of money. So that is it with the money measurement. But basically, we assume that we quantify every activity in order to record it. The other concept is the Prudence Concept or the conservatism. Okay, the conservatism. Yes, Benedicta, if a sole proprietor acknowledges the business as a separate legal entity, he or she will still have an unlimited liability. Okay, that is one of the characteristics of a sole proprietor. Okay, because it is assumed that you take decisions alone and you don't have anybody to share with you in management and ownership. So if the business is winding up and you have outstanding debts to pay, we can sell your property and sell your personal assets to pay. Okay, so that is the implication of unlimited liability. Okay, let's continue. Yes, Louisa.
Madam, please, with the business entity, you said if we shouldn't record activities related to the owner, but what if the activity or transaction undertaken by the owner has a direct connection with the business? Will it be recorded?
No, Louisa, don't get me wrong. I didn't say that you shouldn't undertake transactions that have occurred by the owner. I only use that to say that sometimes students get confused. When I use my name, let me assume it is Edem Water Company, and I go and say Edem bought. Somebody will go and put it under my name, Edem. Do you get it? So I am not saying that don't record when Edem, no. If it is a sole proprietor and Edem withdraws, I've withdrawn out of my capital. So you would record my drawings and hit it against my information, okay, which will be capital in the financials. Are you okay? Okay, yes. Solomon, yes, Solomon. Solomon, your hand is up. Okay, I guess it's a mistake. Okay. Yes, Abena services are also quantifiable. Okay, so if you ask me how you quantify it, if you are into consultancy, they equate it to your hours and your level of expertise. So in the accounting firms, the KPMGs, they quantify their services, okay? If they have to come and prepare financials for you, depending on the grade of the person, if a manager is coming, they'll tell you that 1 hour is maybe $500. They have quantified that. Okay, so the service has been quantified. I teach at the business school. For you, it is regular and paid salary. But for other courses that we teach, which are fee paying, they have quantified the value of each hour. Okay, and so you take it per the hour, number of hours that you teach. So we can quantify services as well. Yes, so whichever way we can quantify services, okay? And that is what most people call the consultancy. Okay, they come and they talk and then they equate it to their level of qualification and the hours they spent. And they pull the bill for you. Okay, so even for us as academics, if we go and teach elsewhere, it is how much you are taking per the number of hours. So we quantify that, okay? So we go on to the Prudence Concept. Okay, the Prudence Concept suggests that the alternative procedures, I'd already explained that, okay, the alternative valuations.
Hello,
and
dear.
Each time the accountant would have to select one, but most often we must err on the side of caution, okay?
55, 5 minutes.
We must err on the side of caution. So for instance, if you have engaged in a transaction and somebody has promised you money, if it is not documented, accountants will not record it. Evidence is the order of our game. Okay, so most often, Josephine Bandy, be careful or I take you off. Okay, so most often it's somebody promises you to give you money and it's not been documented anywhere. Okay, we don't run to record it in our records that, hey, I'm going to get money as a business. No. So we don't anticipate for profit. But if you, as a business, if you have a case in court and you see that your chances are that you may lose, you quickly have to provide for that loss in court, okay, in order to help you account for it. Solomon, I'm yet to know which concept prevents people from taking money unnecessarily, okay, from the business. What you are acting for and on behalf, the business entity, once you act for and on behalf of the business, you will be paid, okay? But to say that you are taking money unnecessarily, sometimes people use various means, okay, of taking those money. And I don't think there's any specific concept. You only have to account for it by disclosing and making sure the information is there. So if you can provide for an explanation to the money you have taken, accountants will record it. Even though sometimes you may have your own misgivings, but once there is evidence to suggest that the expenditure has been made, okay, the only issue where accountants will raise an issue is when the evidence and the amount is not reasonable. Then they would have to raise an issue, especially the auditors. Okay, nowadays, yes.
Madam, please, I didn't get that, so I didn't get the concept very well. Can you please go over?
Now you didn't get what?
Thank you. I didn't get the prudence concept very well.
Okay, so I'm still on the prudence. So the prudence concept, I'm saying that there are various procedures and various valuation methods, okay, that allows us to do one or two. So you come to realize that sometimes the accounting standards, you may opt for this or you may opt for the method B. You have method A and method B. For those of you who have done accounting before, depreciation methods, you have straight line, you have diminishing balance. Which method do you opt for? Okay, and we are saying that for prudence, we expect or we assume that as accountants, you would take the one that gives the most cautious presentation of the financials. Okay, because we don't want you to be too over anxious about reporting profits. So businesses should not report profit when they are not sure. Same way when there are different alternative methods and procedures, take one that is more cautious. That would allow you to, it's just like some people brag. Okay, for accountants, we like to do it very calmly. Okay, you must do it very calmly. Again, okay, as I was saying, everything is evidence. So if you envisage that somebody has just told you, oh, by 2 weeks' time, I'll give you the business money. You don't rush to record. Once you have no evidence of that money. The evidence is either it's been documented or the money has come. In fact, the money must come before you record. But if you have a case in court and your lawyer is telling you that there's a 90% chance that you lose the case, we say quickly go and reduce your profit. So you show realistic figures. Okay, that's what we mean by being prudent. You should be realistic in all your recordings, okay, and not over exaggerate or overestimate things, especially when it comes to profits and cash, okay, because sometimes profits are not really cash. So if you over exaggerate and it doesn't come, your financials looks very good, meanwhile you don't have cash to work. So you need to be very prudent. Then the historical cost concept, and this is where I would want to explain in relation to the going concern. Now, the historical cost concept allows us or assumes that assets and expenses can be shown at acquisition cost. So for all those who have phones, we can decide that our phones or the laptops can be shown at the cost at which we bought them. Okay, over a number of years, that figure can remain on our financials. And we are doing this because it is the most objective means, okay, of assessing the cost of that laptop. Why am I saying it is the most objective means? Because when you bought the assets, that laptop, you were given a receipt. And that receipt is what we use to record in our books that on this day, this company bought a laptop, okay? Yes, there are other ways we can record assets and expenses, but because we are also assuming that the business is a growing concern, means the business will continue, will never stop. That allows us to record the acquisition cost, because everybody who comes and wants to know how much did you buy the laptop, we can quickly go and pull the evidence in the form of the receipt or the invoice. Now there is also other cost, which is the market value, okay, which we can use. But sometimes the market value depends on which market value you are using. Somebody can say, oh, my market value is based on the values at Spintex. Somebody can say my market value is based on the one at Makola. It is not, you cannot verify it because we don't have a consistent market. So it is problematic. Yes, Kesik Charisma, either you type your question or you raise your hand, okay? So that is it. So because we assume that the business is a going concern, it means it will continue operating. It has no plans of stopping its operation. Then we assume that you can use the acquisition cost, okay? But the point at which the business is no more operating, as we saw in all the banks that collapsed, that were liquidated, at that point, you have to use the market value, okay? So anytime the business now intends to shut down, you must stop the acquisition costs, okay, and use the market values, because it is the market values that we'll use to sell the assets to be able to pay everybody. That we must determine the current, at that point in time, how much that asset is, how much that equipment or laptop now is, how much we can raise. Until then, we are allowed as accountants to use the cost at which we bought it. So you can buy a car, 5 years, 10 years, and in your books, you still see that $10,000 equated in cedis in your books. It is because we assume that the business will continue forever. Mm-hmm. A realizable value is how much you would realize when you sell it after taking out all expenses. So if today I want to sell my laptop, maybe I may have to look for one of you students who are quick to get somebody who needs a laptop to buy. And maybe you say, madam, when I do it, give me 10%. So my realizable value would be my costs or the amount I expect to sell the laptop minus your commission. That will give me my realizable value. Okay. Yes, I can see 2 hands up. Could you keep your questions? Let me finish. We just have about 4 slides. Okay. So those whose hands are up, Angela and somebody else, hold on, jot your question. Let's finish and then we can have time. I hope you don't have any class after this. Ben, do you have a class?
No, madam.
Okay.
Yes,
so,
madam, please, some of us do.
Okay, so the next one is the consistency concept. Again, we saw consistency under the qualitative characteristics. So consistency is the fact that you should treat like items from one period to the other. So the way you treat the transaction, if you see a similar transaction over the period and from one period to the other, please treat it in the same way. Don't change the goalpost. Okay, for periodicity, it suggests that because businesses have a long lifespan, we cannot wait till the day they are shutting down or liquidating to put all their financial information together. So we break their preparation period into intervals. So for instance, some businesses have 12 months. In fact, most businesses do 12 months. It could be January to December. Somebody could do April to March. Somebody could do July to June. That is at your discretion. But all we are saying with the periodicity concept is that we are assuming that because the business will continue forever, and to help us make decisions at some time, we need to break the period for financial statement preparation, okay? And so we have periods. So you would realize that as we go along, it will be statement of financial position as at today, as at the end of April, okay? And for the period, so your period could be January to March, you can prepare. It could be January to June, you can prepare. That is your prerogative, okay? Then we also have materiality. Materiality talks about the fact that in accounting, as I indicated, we compress most of the information into significant issues, okay? So we only disclose the important and that doesn't mean that the non-important ones we don't, no. So they are all captured. Let me use the word captured. They are all reported under one bulk, one big name. So for instance, we can have expenses or we can have utilities, and utilities could represent telephone, could represent water, electricity, all that could represent utilities, okay? So we will disclose the important and key information on the face of it. When you go to the notes, you would see the breakdown there. Okay, you see the breakdown of utility, how much water, how much electricity, how much phone. That is the materiality concept. So on the face of the financials, you would see the bulk figures. Then we have substance over form. Okay, now the substance over form concept suggests that sometimes we look at the economic substance, the economic circumstances of the transaction and not the legal. We know that every transaction must have a contract, especially where there are big transactions, to enable us prepare, to enable us record. But there are certain times where the economic circumstances require that we should record it. And I'll give you a typical example. If you take the Obuasi mines, they require heavy equipment, excavators to go under there. Now, sometimes the mines don't have the money to buy these excavators, so they go and hire purchase it. Hire purchase suggests that you've gone to rent it. It is legally not yours. It is still for the hire purchase company. But sometimes when you rent it for so long a period that eventually, at the end of the period, nobody else can rent it. So eventually the company sells it to you. So the issue is between the period you are using it, can we assume that it is for you? Under those circumstances, accountants will record it as assuming that it is for you. And there are criteria for you to fulfill before we do that recording. And so that is the substance over form. The last one is, I want to finish so that those who have to leave for class can leave. Okay, so the rest of us, the explanations, we can go through it. I can clarify it for you, then we can pick it. So please bear with me. The last one is the duality concept. Now, the duality concept suggests that every transaction that we have, okay, affects two aspects. Within the transaction, there are two items that is affected of the business entity. Of the business entity, not the one managing it. And that is one thing you must note. Of the business entity, there are two aspects or two items within the business that is affected. And so you must look for those items and record it. And that is the basis of the double entry system, which we always refer to as, oh, accounting. Everybody say for every debit entry, there must be credit. For that is the double entry. Okay, double entry suggests that every transaction, and by now we all know transaction, has two aspects to it. And accounting will show the effect on those two aspects. So what has happened to this aspect? What has happened to this aspect? Not the manager, not the one managing, the transaction within that has occurred within the organization, and that is the duality. Now, if you fail to do the two aspects, we see the pendulum. It is shifting to one side. It will not, there will be an imbalance in your information. And so it is very necessary that we always make sure that we record twice. And we'll come to that as we delve and start the recording next week. Okay. Finally, the basis of accounting. How do we account? How do we even start the recording process? Okay, and I did indicate that every activity that is quantified must be accounted for. But there are two bases. The first one suggests that we only record when we have received actual cash or have paid actual cash. Okay, so businesses only record in their books when they have actually received cash. When they see cash in their hands, then they'll record it. And when they have paid out cash, then they'll record. That is known as the cash basis of accounting. On the other hand, you could also engage in the transaction with or without having received cash. And the question is, will you record it? So that is the accrual basis, okay? That allows us to record transaction irrespective of whether we have received cash or not. So if I buy water from Belapa, Edem company purchased water, Belapa on credit. The mere fact that I have bought it on credit, I can record that as purchases, even though I have not paid. The only thing I have to do is to make sure that I am recording the amount so that when I have to pay Belapa, I can identify how much I have to pay Belapa. So these are the two bases of accounting and the starting point. Now, for purposes of this semester's teaching, we may be dwelling mostly on the accrual basis, where we would record whether or not we have received cash. Once the transaction has occurred, we will do the recording. Okay, so thank you very much. That brings us to the end of lecture 2. I will take your questions